Welcome back and thanks for joining us. I'm Courtney.
I'm Kenneth.
And this is From Launch to Legacy, where we talk about everything it takes to start and run a small business. Last time, we talked about the top 10 tips for 26. And today, we are going to start with understanding your financials. And then next time, we're going to go in a little bit deeper. I wanted to go ahead and say it up front so that these guys know, I need a little more. All right. Well,
this is understanding that we have interpreting.
Yes. So be prepared to come back next week or listen to them straight through. Want you guys to remember, like always, there are checklists, guides, sample questions, charts, graphs, all kinds of free resources on our website, www.havensconsulting.com. Go to resources, podcast guides. They are labeled by episode, and then there's extras that go along with it that were launched on the same date. So that's how you can find all that great information. So let's get started with episode 23.
Wow.
Understanding your financials, the basics every business owner should know. So today we're going to talk about the secret language. To you, it's just language, but to some of us, it is something.
It's hieroglyphics to most people.
Yes, we don't understand it all. So, but after today, we're gonna know what it is, right?
Yeah, because it's not complex. It's not that difficult. It's just foreign to a lot of people.
So we are gonna empower the new or early stage entrepreneurs today, and then more advanced next time, so that you can confidently read, interpret, and use the most common financial documents.
Yep. And actually, this is going to be for a lot of companies. I mean, companies have been around for years, do millions of dollars worth of revenue, still don't have financials that are anything.
Yeah.
I mean, we run into that all the time. That's, we even go in for process or managerial consulting. I want to see your financials, because that's going to tell me more than anything, even if we're not doing any sort of financial consulting.
Yeah.
So if without that information, even if it's garbage, that's good information,
right?
Because that tells me, all right, this is where we're starting.
This is where we need to start.
Yeah.
Okay. So today you are going to know how to identify the 3 core financial reports, know what questions to ask your bookkeeper or accountant if you have that, or yourself if you are doing it all alone, how to spot some early signs of financial trouble, and to set up some simple habits that you can help keep your business healthy.
That's right.
Okay. Why does this matter?
Your financial statements, I mean, we say this a lot, they're the story of your business, and they can tell a true story or they can tell a fictitious story. And if they're telling a fictitious one, that they're not useful. So understanding how to pull the information about your business out of these it's the single greatest tool you can have for decision making. If they're not accurate, if they're not complete, if they're not available, if they're irrelevant, we'll talk about audience in here, and I talk about that anytime we do kind of an accounting cleanup for someone. Is don't make these more complex than they need to be.
Yeah.
Who are your audiences? It's management should be an audience. Maybe banks or maybe regulatory agencies. Who's going to look at these, and what information do they need? Don't put any more in there, because it just overcomplicates it. I always tell people, don't let your accountant make your chart of accounts. They'll make one for every transaction. And it'd just be overcomplicated. You don't need that. If breaking something down in more detail doesn't provide any use to anyone, that was a mistake. You made it more complicated without any benefit, and that just opens room for errors, which will hurt your financial reporting.
All right. So what I have here is that financial documents are like your decision dashboard.
Yep.
So if you ignore them, it's like driving with your eyes closed.
And no steering wheel.
Oh, okay. So even more complex.
Your brake line's cut.
So we heard this in our last episode, but 82% of business failures stem from cash flow mismanagement.
What are the other 18%?
I don't know.
I'm like, I thought this was 100. I mean, obviously not 100. There's other reasons, but
So this is super important. So our goal, of course, is to understand the story that's being told.
Yep.
Before it becomes a crisis.
Right.
Okay. Quick win for you guys is to block out 30 minutes this week. Open your most recent profit and loss statement and highlight any number you don't understand.
Yep. And this is not, there's nothing to be embarrassed about.
Mm-hmm.
You can highlight the account that says cash if you need to. Your ego needs to be thrown out the door right here. It's too important to not fully understand. So this is great advice. I love this that you put in here, but you need to do it and you need to be honest with yourself.
Okay, let's talk about the core 3 documents. Number 1, your P&L.
I hate that term.
Profit and loss statement.
Hate it.
Sometimes called income statement.
That's the one I prefer.
Okay.
Not that it's wrong. Profit and loss is the standard, but I don't like it because you can't have a profit and a loss.
I see.
If it was called a profit or loss statement, I'd be way more on board.
Okay.
But it's a profit and loss statement. And I'm like, that's not a situation that occurs in reality. That's not how numbers work.
Okay. The purpose of this document is to show your income versus your expenses.
All 3 of these statements have a different purpose. They have different information they're trying to convey to you. And you also need to understand the timing of these statements. So income statement, as opposed to your cash flow statement or your balance sheet, spans a period of time.
Okay.
That will cover, and it can be any period of time. It can be a year, it could be a day, it could be a decade, whatever you want it to be, but it will span a certain amount of time. While the other 2 statements are what we call snapshots. They exist for the instant in which they were ran. That was a true statement. So you can think about this as, how much did I spend this month on on gas? That's in your personal life. So that's your income statement. And how much cash do I have in the bank? Well, it depends. When did you check it?
Yeah.
That's your snapshot.
Okay. Let's go a little deeper into each statement. Not fully in the understanding, interpreting part. We'll do that next time, because if anybody's hearing these things for the first time, I want to make sure that they understand what these things are, and then we'll go into detail. So what you're saying is the income statement is, did we make money during this period?
Yeah, for the period I'm looking at, what money did I earn and what expenses did I incur? Now, I was very specific with those terms, because it's not what cash did I receive or cash did I spend.
Right.
We'll talk about that when we get to the cash flow statement. And if you listen to the last episode, we talked about that a little bit. And if you didn't listen to the last episode, go listen to that. This one is, the income statement is, this is the story of your operations.
This time period.
For that period, yeah.
Okay.
This is the story of how your company is being ran, how things are happening. That's why it's over a period. It's dynamic. It moves, and you get dynamic information off of it. And it's the only report in which we do that. The others are snapshot, and that's kind of a state of being at that time. And they're used for different purposes. So this is really, over this period of time, how did my company perform?
Okay.
And we'll get into why, profit does not equal cash. I've seen companies that were cash rich, or not cash rich. They were, I actually have seen cash rich. It's a whole different problem. Profitable companies on paper, and they go bankrupt.
Yeah.
And we can get deep later on, and into some of the more complex stuff about the accounting and these financial statements. But here today, I just really want you to know that what these statements are used for, not how to read them, what they're used for, and just the basic information that's on them. So this is how your operations performed during a period.
Okay. And the key components are
revenue, your income, your expenses, which will usually be broken down into 3 to 4 categories. You'll have what's called COGS. So those are your cost of goods sold. If you sell cups How much was the material for the cups that I sold? Then you have operating expenses. These are expenses that maybe you've got to run the electricity at your place. So it's necessary for operations, but it's not directly in the thing you sell.
Okay.
And we have what we call administrative, or you'll hear SG&A, sales, general, and administrative expense. These are things that your business needs, but aren't really related at all to the product. So
Okay.
your Microsoft Office subscription, you need it, but it's not related to your products or the actual operation of your business. Now, I know you need it to operate. It's not used in what you do directly. And then you have other, which is like interest, amortization, stuff like that.
Okay.
So you'll have your expenses, your income, your expenses, and then
the result.
A negative or positive number, which is net income or net loss.
Okay. What I have to watch for on this statement is large expense categories creeping up month over month.
Yeah. You can set different thresholds depending on your company. One of the things I want to look out for when we're looking at over a period, especially if the financials are already well put together, we'll set a variance, factor that I've seen it. We've set it as low as 4. I've set it as high as 15. But if you've got a month over month change and you've got like a 10% jump this month in this category, what was that? A lot of times it's a misstatement. It was just something put in there incorrectly. It may be you had a higher expense, but then you need to understand, do we have higher income, or is this a recurring? These are questions and that's why the story is so important in the truth, because you can ask better questions and you can make better decisions.
Okay. Next up, we have the balance sheet. So I have the purpose is what you own, your assets, what you owe, your liabilities, and what's left over.
Yep. And what we own and what we owe are a little more abstract topics. Again, we'll talk about that more in the interpreting. But yes, this is essentially what this boils down to is, what do I owe, what do I own, and what's left at the end. This is what's called the fundamental equation of accounting, or the fundamental accounting equation. Assets plus liabilities liabilities plus equity equals assets. And if you think about that, how did I get the money? If I have things in this business, how did I get them? I either borrowed money to get them, or I put money in myself. So it's liabilities, a loan, or equity, or they're from the company's operations and net income, which is also in equity. That's why they have to add up and they have to balance, hence the balance sheet. So this is really where you're going to see the long-term health of your company. You're going to see an instantaneous, but it's going to be accumulation of every past transaction that's hit every account on here. It doesn't ever get zeroed out at the end of the year like your income statement does. This is accumulation of events.
Okay.
And this will tell you kind of up to now how healthy your company has gotten. And we'll talk about some financial ratios and stuff to test that here in a minute.
Okay. The thing I have to watch out for on the balance sheet is high credit card balances or uncollected receivables, which would be money you've earned but not yet received.
Right. And we'll get into accruals versus cash basis and cash versus income here. You want to look for anything that is either not ordinary or looks like it may be incorrect or has a concerning proportion to something else. Because having $1 million in credit card debt when you do $50 million of revenue a year is not concerning. Having $10,000 worth of credit card debt when you do $2,000 a year is extremely concerning. So the nominal values there are not going to be as important as the relation of these items to each other. And again, we'll talk about ratios here in a minute, or possibly in the next episode. And those things, it lets you know how you got to where you are now. Are we having to borrow to get here, or putting in personal money, or is this generated from our operations, which is the ideal scenario, but this will give you the state of where everything's at. You'll know how much cash you have, how much debt you have, your fixed assets, your vehicles, if you have a warehouse or a building or an office, anything you own that's would be difficult to sell.
Okay. All right. The third statement that we are going to look at is cash flow. So I have the purpose is it tracks the actual money in and out.
There's two types of cash flow statements, and you'll see one type almost always, and we won't see the other one hardly ever. There's what's called an indirect cash flow statement and a direct cash flow statement. You will almost never see a direct cash flow statement. A direct cash flow is literally where the money went each time. So over a period of time, you're going to look at, okay, I spent money on X, Y, and Z. The indirect, which is much more easy to calculate, but gives you essentially the same insights, just looks at changes in account balances over that time, but they will translate into real world cash moves.
Okay.
So if you're looking at your accounts receivable balance and it goes down over this period, that's an increase in cash. Even if you had more receivables go in because you got paid more than you billed, and that's why it went down. And so all of those accounts, almost every account, you have non-cash transaction accounts that won't be on there, and we'll talk about those in the next episode. But the indirect cash flow gives you a very broad idea of how your company's doing. There's three buckets on there. There's the operating cash flow, the financing cash flow, and the investment cash flow. When I worked at the bank, if I had to say what a cash flow statement I want to see, that if I've got to present, the one I want to see is it's got a negative investing cash flow, it's got a negative financing cash flow, and an overall positive cash flow. So what this tells me is the company is paying off debt, they're buying assets, but they're still bringing in money, and the only way they can be doing that is from their operations. If you're seeing positive cash flow from financing, negative from operations, that means they're borrowing money to sustain, or, negative investing, they're selling big assets to run the company. So there's three main parts here, and it's going to be an indirect calculation, but it's going to give you essentially all the information that you're going to need that you would get off a direct cash flow.
Okay, so what I have a quick win for your cash flow statement is to open your bank statements, look at the last 3 months, and average your cash in and out.
Yeah, that's a great way to do it. If you don't have if your financials aren't put together, you can't access that financial statement. I mean, that's more of a direct cash flow method, but that's going to give you, at least knowing if you've got a positive or a negative cash flow. And that's one of the first metrics. If you don't know if your cash flow is positive or negative right now, that's a big red flag. Go find that out right now. Drop whatever you're doing, drop the baby, drop the dog, do everything. Go find out if you have positive or negative cash flow.
Okay, so we have our 3 documents and the basics on those. So let's talk about your chart of accounts. So I have that this is your financial filing cabinet.
Mm-hmm.
So it's like the master list of all of the categories, right?
The chart of accounts is one of the places that I almost never see it done well. There is a lot of subjectivity in the chart of accounts. There's not necessarily a correct way to do it. There's definitely gap compliant, and there's definitely things you should not do.
Mm-hmm.
But whether or not you break insurance, you have an expense account that says insurance, or you have an expense account that says insurance, and then below it, it's auto insurance, general liability insurance. That is.
So you're talking about, so when you're doing the chart of accounts and it's all the different categories, it's how far you break down each category.
Right. And you want to have, this is where we talk about audience, right?
Mm-hmm.
So who's looking at these? Don't break this down. If you don't need to know if it's auto insurance or if it's, which you probably do, but a lot of times those are single monthly transactions. And if it's a low volume, company, you can still lump those in together, and you can see, it's Geico, it's the Hartford, and how much those cost. That's a lot of times better if you've got 4 transactions of insurance than having insurance and then 4 sub accounts that have a single transaction every month. I mean, you've got too much nuance. And now
Okay.
your financial statement will get too busy and you'll get lost trying to read it.
Okay, so you want to take your chart of accounts and you want to list out everything,
Mhm.
right? All of your money into all of your categories, but you don't want your categories to be overly sorted.
And there's a test here. Take your current chart of accounts, whatever it is, and go down. And if you go, well, what's in this? It's not broken down enough.
Okay.
And if you're going through and you like run across and you're like, why are there so many insurance accounts? I just need insurance. That's too broken now.
Okay.
Unless there was a specific purpose or audience member that was designed for. Just because you don't use it that way doesn't mean someone doesn't. But if no one is, and you've broken it down more, you've created more opportunity for errors.
Mm-hmm.
You've created an overly complex chart of accounts. You've made your financials longer than they should be, harder to read. And this is why I always say don't let your accountant make your chart of accounts, because they'll make one for every transaction. My favorite, I think I mentioned this on a few episodes ago, at the last place we worked, was Check for Gary. Yeah, that was the name of an account on the chart of accounts. And that transaction was from like 1998. When you set up your accounting software, it's going to ask you some prompting questions about your industry, about your company, about some things you have. And it's going to set you up I'd say a 70% accurate, probably chart of accounts. But what we see a lot is people just don't go in there and get rid of the ones they don't need. And or they have QuickBooks has some accounts that it makes that you can't get rid of. And it makes me want to, I pulled all my hair out already.
If you guys don't know what Kenneth looks like, he's bald.
This is what did it. There's the uncategorized asset account in QuickBooks, the opening balance equity account, which I hate, but people don't go clean these out, or they've got fixed assets accounts and they don't have fixed assets, or inventory, or just says inventory asset, and that's their entire inventory tracking. There's a lot of, you need to go in there and make sure you've got the accounts you need and get rid of everything you don't. If we do a financial cleanup, the chart of accounts is one of the first things we attack. And I just run a 2-year, it's called a trial balance. Actually, we run the general ledger for this part. And we just look at every transaction that happened. And if this account hasn't been used in 3 months, it's questionable. If it hasn't been used in 6 months, it's almost certainly getting rid of it. And if it hasn't been used in over a year, because there's some transactions that are just annual.
Right.
If we get down to if you haven't had one in a year, I'm not letting you keep it.
Yeah.
I'm not giving you an option. I'm telling you it's gone. This could be rolled up. You don't need a whole separate account for every 3-year transaction. Put it in a more general account and move on with life. Otherwise, you're going to have these 0 accounts for years and then something pops in there.
Okay. So the quick win that I have for the chart of accounts is to either yourself or ask your bookkeeper, whoever's doing your books, to print out your current chart of accounts and then, go through and highlight any category that you don't use, merge the ones that you do, and just to talk with whoever's making these decisions and clean that up.
Yep. Or if you I think, did we talk about this earlier about, if you don't understand what an account is, if you go to that chart of account and highlight that and ask them,
Yeah.
they better be able to explain it to you. If it's on your chart of accounts and they're doing your book, so they can explain to you what an account is, find someone else.
Okay. Next up, we have some basic bookkeeping rhythms. I want to make this super clear. Even if you outsource your bookkeeping, you're still responsible for understanding what is there
and maintaining it.
Yeah.
The IRS doesn't care if you don't file your taxes because your books aren't done, and the IRS comes, they don't care if your bookkeeper didn't get it done.
Yeah.
They're your books and you're responsible for them.
And if you don't understand something, ask your bookkeeper, accountant, whoever, and have them explain it until you do understand it.
Yep. And there will be some things that they may not be able to answer off the top of their head if there's some digging that has to happen. There shouldn't be an account that they don't know what it's used. They may not know what you use it for. If
Yeah.
you made up some crazy account and it's like cat litter and it's like, why do we have this? Or whatever it is. But if it's a standard account, they should be able to explain depreciation, amortization, fixed assets versus natural resources, and all that. If they can't, they're probably swimming in a little deeper waters than they probably should, and that's nothing against them. They a little more education, but don't let your bookkeeper's inexperience hurt your company. It's not your job to train them up, and it's not your responsibility to make sure that it's your responsibility to make sure that they're up to snuff, but not to get them up to snuff.
Okay. The two number one things in bookkeeping I have for business is that your business and personal must be separated.
Has to be.
And then the power of timeliness, which is record the transactions as they happen. Don't wait till the end of the month or quarter or a year and try to do all of them from memory. So try to do this as often as possible.
If you've got a system like QuickBooks, and I imagine you're not a business owner that doesn't have a smartphone. I imagine you're not walking around with a Nokia brick or a flip phone. All the major accounting softwares have apps. They have Receipt Snap. Take a picture of your receipt, put your transaction in, then it takes 15 seconds. And I know you're in a hurry. You're always in a hurry. You're a business owner. Everything's on fire always, and you're late to put it out. It doesn't matter. Those things, it's the biggest problem I see. It's the number one financial issue I see is just a lack of maintenance. And that comes from poor processes. I'll do it later. Or that I can handle my own books. And then they get in there and they're like, I don't really understand where it was. I'll just do this later. But the thing is, both those people don't ever do it later.
Yeah.
If you don't have time now, you're not going to have time for a 50 times large pile at the end of the month. Don't touch your books any less than weekly. You should be in there daily, but don't do it any less than weekly. I can't imagine not logging in every day. Just make sure that my bank balance is where it should be. And there's not transactions I'm not aware of, popping through. But if you're doing that once a week, someone steals your business credit card number and you don't take a look at your finances for a week, it'd be a big problem.
Okay, so I have this checklist. Now I'm a little worried to say the monthly checklist, but on my checklist, I have reconcile the bank and credit accounts.
Correct. Monthly.
Review P&L and balance sheet.
Correct.
Categorize uncleared transactions.
Yep.
Record owner draws. Review the aging, your accounts receivable, and your accounts payable, and save your receipts and backup files.
Yep. And again, you can put these transactions in as often or infrequently as you like, but the further down it goes, the bigger the job becomes. And so I don't let more than 15 items build up in a backlog. That's your rule. Don't let more than 15. So if for your company, that means you do your books every 2 months, great. If it means you do them every 2 minutes, great. If it's every 2 minutes, you need a full-time staffer. You don't need an outsource. You don't need a consultant. You need a full-time staffer. But if you're having 15 transactions every 2 minutes, you're probably doing millions of dollars in revenue, and so that's fine. But it causes so many problems when you don't keep up with your books. It's the single most important, valuable piece of information that you can have about your company, and to just not have it, to just not. And like I said, we see this all the time, and people don't do this intentionally. They don't get here by just like,
because they don't own an accounting firm.
Right.
They make cups.
Yes.
So this is not in their wheelhouse.
Right.
And it is not the most important thing to them.
Right.
Though it sounds like it should be.
Yes. And the most important, probably not. Your operation should be, right. but this is part of your operations. This gives you the insight in how to run your operations more effectively, more efficiently, more properly. It lets you know when to order your inventory restocks, or liquidate this old fixed asset we've got because it's not doing any good for us anymore. Whatever that is, it's a record of the past and a roadmap for the future. And not having it is like not having any idea what's ever happened historically or any context of the world around you, and then going and trying to live your life. That's the equivalent of trying to run a business without adequate financials.
Okay, last up for today, we have understanding taxes and compliance. Now, of course, this is just going to be a little bit. This is not full understanding. This is just a broad view for people who are listening to the episode. So I have some basics that you can't ignore. I'll give you the title. You tell me a little bit about it. Okay. Quarterly estimates.
Okay, so these are, if you've had a W-2 job, which I'm assuming almost everyone has, that's if you're listening to this podcast, you have withholdings, tax withholdings for your Social Security, your Medicare, your taxes, and other things if the company has like insurance. But those three things are taken out of your paycheck, and your payroll provider, your company, whoever's responsible for remitting that money, and the record of who basically is paying it to the federal government and state government, depending on if you're in 42 states, you have a state income tax. Not here in Texas. Those are sent for you. When you own a business and your money is coming in to the business, not to a W-2, your clients don't swipe a credit card and then part of that goes to the IRS, right? You have to make quarterly estimated payments. This and payroll tax are the two ones I see neglected the most. These are the biggest tax problems that we've encountered through our years of consulting. If we go to do someone's taxes, or we're doing tax planning and strategizing, or just a cleanup, and it's all right, well, what estimated taxes did you? Well, I didn't pay any last year. I just pay them at the end of the year. Well, you're going to have fees. You're going to have interest that the IRS is going to accumulate on you. There's some safe harbor rules, and we can dive into estimated quarterly taxes. Can be their own episode, but one more thing on them is they're not 3-month quarters. There's a 3-month quarter, then there's a 2-month quarter, and then there's a 4-month quarter, and then a 3-month quarter, I think. Or it's a 3-2, 3-4. We'll get those dates on, they're on the IRS website and everywhere else, but you need to be aware of those dates. They're going to be in April, June, September, and January for those dates. And it's a complicated process because you're estimating. That's another one that people ask when we help them with the estimated taxes is, what is this? This is what I'm going to owe. No, I have no idea. Mm-hmm. This is what we're calculating based on the information we have up to this point. Especially if it's first quarter, it's like, I don't know. I've seen 3 of your 12 months. I have no idea how your year's going to land. You could go gangbusters and make $1 billion, or you could go bankrupt tomorrow. There's no way of doing it. So, but you can be penalized for making more money later in the year. But there's some ways to avoid that, and we can talk about those in a later episode. But your quarterly estimated taxes, if you're not paying those and your company has made a profit at all, you go fix that.
Okay. Your annual return.
We file a 1040 as, individuals. Your business may just report on your Schedule C on your 1040, or it may have its own tax return, depending on how your business is structured. File these, because some people don't. And the IRS doesn't forget. People are like, oh, well, they can only look back 6 years. They can look back on an event that hasn't moved in 6 years. So if you filed a return 6 years ago, they can't go back and look at that. If you haven't filed it, this is an active return. They can look back at that 40 years from now if they want. File your taxes.
Okay. Next up, we have sales tax.
So this is a whole different type of tax. This is called transactional tax. And every state does this different. Some states don't have it. Some states have a flat rate. Some states like Texas and Ohio have extremely convoluted, complicated where over the past 100 years we've written in exceptions for this and additions for that and lower rates for this, and no one's called Haven's Business Services and had that process cleaned up and made it more efficient to get rid of their process bloat, and so it can be overly complex. If you live in Los Angeles and do business there, you have to file a state sales tax return, and then you have to file one for Los Angeles, and you have to break down all of like the 150 cities how much you did, and they're monthly or quarterly depending on how your business is set up. We used to have to file these at a place that I was the controller of, and California sales taxes. I I don't touch taxes in California, period, anymore. I just don't.
Okay. Last up, we've got payroll tax.
This is actually the one that if we have a client with a tax problem, it's surprisingly this. It's not estimated with their annual, it's sales tax a lot, but having a garnishment for back 941 wages or 940 wages or payments, which are their income tax returns for your employer files them for all the people that they took payroll tax out for, and they have to file those quarterly or when it hits a certain balance. But that's pulled out of your paycheck, and the payroll processor your company holds it. And if they don't send that to the government, like you can go years without someone picking up that you didn't file an annual return, because this is someone else's claiming, and they're like, well, we didn't get this money, and you claim it the next year. They're going to catch this like that. So you have to pay this. If you're using a payroll processor, it's just coming out automatically. They're handling it. Do that. You shouldn't be calculating your own payroll tax deductions from your employees anyway.
All right, that is it on the understanding taxes. Next up, we have connecting your financials to your daily decisions. So, this is just telling you how the financial document answers the different questions. So, your profit and loss or your
Income
income,
statement.
the main question that it answers is, are we profitable?
Yeah. Or are we adequately profitable? Or is there a hiccup somewhere? Again, this is the statement that really gives you the insight into your operations on a ongoing basis for that period. So looking at this, this is where you see, is the overall operation making money or losing money? And if either, what are the drivers? That's where you'll find this out.
Okay. The balance sheet, the main question that it answers is, what do we own versus what do we owe?
Yep. And so this is the accumulation of all those profit and loss statements and all your owner contributions and debt. That entire profit and loss statement appears on your balance sheet as a single line in equity. There's a net income line. It should match your income statement net income. If it doesn't, call a professional. We've broken everything if those don't match up. But this is your overall state of being. So your profit and loss, you go to the doctor. This is what I ate. This is my exercises, the medications I took, and your balance sheet. This is your cholesterol. These are your stats. This is where you're at now based on these things that happen.
Okay, last up, we have the cash flow statement, which is what can we afford next month?
Right, or right now, do we need to adjust our payables time frames or our receivables time frames or our inventory ordering or whatever to not affect the profit adversely, but make sure that we have cash to operate?
Mm-hmm.
Because like we talked about earlier and in the last episode, you can be making a profit and be cash poor and get yourself into a big bind. So that happens when you generally run on pretty thin margins in a unsustainable growth pattern, and then you get boxed into a lot of long-term contracts, and now you're cash poor. That's usually how we see that happen.
Okay, well, I hope that helped you guys out and that you understand your statements and you have things to look for. A couple of questions that you can ask yourself is, which report do I look at least often and why? And if it's I don't understand,
Yep.
then you need to talk to someone. Which numbers feel most confusing right now and why? And what is one monthly habit that I can start to increase financial clarity? Let's start with talk to whoever is handling them, right?
Right. Whether that's you, an employee, or a third party individual, talk to them and get, like you said, go print out your chart of accounts
Mm-hmm.
and your latest financials. Highlight numbers on the financials that you're like, why is it this good or bad? Why are sales $10 million? I thought we did 5,000 last year. That's a serious question. And on your chart of accounts, any account that you're like, I don't know what this is. What is accumulated depreciation? That's an excellent question. I would say less than 1% of people know that. It's not a complicated answer. It's just a rarely encountered
Mm-hmm.
question. So there's no stupid questions. And I think the reason most people get in trouble is because it's this weird area of a business that people have enough experience in with their own personal finances to get themselves in trouble.
Mm-hmm.
So no one ever is like, I'm getting sued. I'll represent myself in court.
Yeah.
Or people will say, I can handle my own books
Yeah.
all the time. And maybe you can. And maybe you're a learner. And when you run into something that you're not familiar with, you go figure it out and you do it the correct way. A lot of times business owners they're really good at the thing that their company does. That's why they started it, and they are blowing and going, and that's in the front of their mind, and this stuff just kind of gets thrown wherever, and it becomes a problem real quick.
Right. Well, that's all that we have for today, unless you have anything else you want to add.
Nope. I mean, that's really it. Next time we'll hop in here and we'll take a little bit deeper dive into how to read these. Now that we know like what information we're looking for,
Mm-hmm.
we're gonna do a 50,000 foot flyover on how to extract that information.
Okay, well, if you are ready for personalized industry specific help,
Mhm.
you can schedule a free consultation on our website, www.havensconsulting.com. If you got value today, you can help us by subscribing so you never miss an episode, sharing with another business owner or anyone that might need some information on financials. Leave a quick review, but only if you liked it, so that it helps us reach other business owners like you guys. We love to connect with you, so find us on social media at From Launch to Legacy or at Havens Business Services. You can tell us what you're working on, drop us a question, just say hi, anything. We love hearing from listeners like you. Like Kenneth said, next episode, we're going to go a little bit deeper on these financials. Until then, keep leaning in, keep learning, and keep building the business and life that you've always dreamed of. We are honored to be part of your journey from launch to legacy.
We'll see you next
Bye.
time.